Good morning, everybody. Thank you for joining us today for our latest webinar, Tax in 2022, What You Need to Know. So today we're going to discuss some tax planning ideas and also covering off some pre-year-end planning actions you may want to take prior to the start of the new tax year on the 6th of April. Please feel free to ask questions as we go along using the Q&A box. If it's okay, everybody, I will pick those up at the end and try to get through as many as possible. The aim today is that this webinar will last for about 45 minutes, no more, and plenty to cover off, and hopefully there'll be something here for everyone. My name's Craig Hughes. I'm the head of tax here at Brown Butler Accountants based in Leeds. Okay, so what are we going to be covering today? Well, we're looking at some changes that are happening in the next few years, but planning ahead in advance of those. So we've got an increase in corporation tax for some companies. We've got higher dividend tax rates, which are imminent from April this year. We already have new capital allowances like the super deduction, and the annual investment allowance is still around as well. There's a freeze on personal allowances and other reliefs. And there is a further expansion of making tax digital, which I'll cover off at the end. Just to let you know, these slides will be distributed after the presentation to the attendees as well. So as far as pre-year-end tax planning is concerned, the clock is ticking. It's important to utilise all reliefs and the allowances that are available before the 5th of April. It's very much a case of use them or lose them in terms of in-year reliefs. There are lots of steps you can undertake, but planning is required to make sure that they are done in an appropriate manner. So let's start off with business tax planning. So we need to consider the position in regard to the following before the year end of your businesses, your companies. As far as dividend taxation is concerned, everybody has a £2,000 nil rate band as far as dividends are payable. And it's important that you utilise that. That's available. So if nothing else, pay £2,000 of dividends. And remember, the tax rate for dividends is increasing by 1.25% from the 6th of April. So you may want to consider whether you should accelerate some dividend payments into this current tax year, as opposed to making those payments next year when the rate is higher. You do need to be careful when considering that in terms of looking at your total income. What you wouldn't want to do is push yourself into a higher income tax bracket overall by doing that. And particularly here, we need to consider that income in between the 100 and 125,000 bracket where you're paying at an increased marginal rate. But it's something to consider. From a corporation tax point of view, just making sure you've made use of all the reliefs and allowances available to you. And bear in mind that from April 23, only just over a year away now, the rate of corporation tax is increasing to 25% for companies with profits over £250,000. And we will then have a marginal relief calculation coming back into play as well, which some of you may remember from a number of years ago. So basically, we'll have the small companies rate of 19% will apply for profits up to 50,000, and then the large company rate of 25% for profits over £250,000. and the marginal relief calculation work out for profits which fall within that band. And when we're looking at those profit levels, remember we need to bring into account associated companies. So that's companies under common control. So it's different to the scenario now with, say, quarterly installment payments, where we simply look at the number of group companies when establishing whether a company is required to pay tax by installments. After April 23, we're going back to the rules which were in place a number of years ago when we're looking at associated companies. So you may want to consider looking at corporate structures in terms of, do you need the number of companies that you've got, in terms of how that will impact the rate of corporation tax. And also from next April, when looking at the calculation for quarterly installment payments, that will also be based on associated companies rather than number of group companies. So you may find that more companies are falling within the quarterly installment payment regime. A couple of other areas to consider as far as business tax planning is concerned. Firstly, capital allowances. Now, the annual investment allowance, it's been up and down, but it's been at £1 million now for a couple of years, and it will remain at £1 million until March 23, the end of March 23. For limited companies, we also need to remember that we've now got this super deduction, which can offer a first-year allowance of 130% for new assets which qualify as main pool assets. There is also a first-year allowance for special rate pool assets at 50%. But bear in mind there, if you do have any of the £1 million annual investment allowance capacity available, it's probably more beneficial to claim that for special rate pool assets than it is for claiming the first year allowance of 50%. Now, the rules are a little bit complicated around the super deduction, but one thing that should not be forgotten is that when you come to sell an asset that's previously qualified or claimed super deduction on, then you will have a balancing charge arising when that sale comes through in future periods. So there's a bit of the maths to do there in terms of establishing to what extent it's worthwhile claiming the super deduction as opposed to the annual investment allowance. The two run along side by side, so you can pick and choose which allowance you want to claim for the particular asset. Now, R&D tax credits have been around for over 20 years now. April 2000, they were introduced. And year on year, more and more claims are being made. As you can see there, there's 7.4 billion of relief that was given last year, a record amount in terms of the relief being claimed. So have a think about whether you have any eligible projects which might qualify for R&D relief. It's a very attractive tax relief just for limited companies. But in essence, it can give an enhanced tax deduction for qualifying expenditure. There are various rules around the types of expenditure which qualifies for the relief. The main one is staff costs. But in broad terms, you can claim a 130% deduction for qualifying R&D expenditure, thus reducing your corporation tax bill. If you do create a loss with that R&D claim, then you can also surrender that loss for repayment from HMRC rather than having to carry it forward. So it can be very attractive particularly in startup situations where it could be a number of years before those profits are made. That loss surrender can help to finance the cash flow of the business. Looking at capital gains now, as far as business tax planning is concerned, and tax planning in general, indeed. The annual exemption. for capital gains tax, 12,300. It is very much a case of use it or lose it as far as this exemption is concerned. You can't carry forward any amount that you haven't used in the previous period, for example. So if you do have any investments which might stand at a gain, but fall within the annual exemption, it's possible to sell those tax-free. Now, of course, you do need to take investment advice as far as whether that's the right thing to do from that perspective, and I'm certainly not in a position to give that investment advice purely from a tax perspective. It should be noted that the rate is now frozen until April 2026. So particularly at the moment where we are living through some inflationary times, the real benefit of that exemption is going to be eroded over the next few years. Indeed, there are a number of other personal allowances which are frozen for that period as well. An important capital gains tax relief for businesses is business asset disposal relief, what we all knew as entrepreneurs relief previously. Different name, but basically the same relief. The lifetime limit for claiming business asset disposal relief is £1 million of gains, and that does include any gains that you may have realised when it was entrepreneurs relief. And like entrepreneurs relief, a business asset disposal relief claim means your capital gains tax rate is 10% on qualifying disposals. You should consider here around the shareholdings in the company or the partnership indeed, in terms of spreading that £1 million lifetime allowance amongst other family members, for example. Since it's been reduced from 10 million to 1 million, clearly the relief isn't as attractive as it was before, but in a simple scenario of spouses, there's £2 million of allowance there between the two of you. As you might expect with this type of relief, there are a number of qualifying conditions. Today's seminar isn't the place to go through those, but needless to say, there are a number of hurdles that you need to get over in order to be able to claim the relief. The main one being, as far as companies are concerned, you need to own at least 5% of the shares in the company for at least 2 years prior to disposal, and the company needs to be a trading company. You also need to think about how the relief works on the sale of the company, particularly in the context of deferred consideration, with either rolling over into loan notes, for example, or in an earn-out type scenario. It's important there that that is reviewed and looked at to make sure that you are maximising the business asset disposal relief claim, because you could lose some of that relief in those rollover type situations without any, if you don't take any forward planning on it. So just looking at some other business tax planning tips. I mean, clearly a wide variety of ways for businesses to reduce their tax bill. It's more difficult now to do bespoke planning outside of the accounts from a corporation tax. And what I mean by that is from a corporation tax point of view. The taxable profit now very much largely follows the accounting profit, capital allowances and depreciation being the obvious exception to that. But when we're looking at the whole in terms of both corporation tax within the business and personal tax on the owners, you can look at salaries in terms of how profits are extracted from the business. The classic scenario with an owner-managed business, an SME, is that you take a relatively low level of salary and the balance in dividend. It is still more tax efficient overall to extract in that way. Although when the rate of corporation tax goes up to 25% in a year or so, that calculation does change and it does become more marginal between the two routes. So what's right now may not necessarily be right in the future. Consideration should be given to the benefits packages, particularly looking around salary sacrifice schemes. Electric cars and charging points are a very tax efficient way of rewarding employees at the moment. The benefit in kind regime is very favorable. They are, for pure electric cars or cars with CO2 emissions of less than 75 grams per kilometre, are excluded from the optional remuneration arrangement provisions. So where you do enter into a salary sacrifice position for electric cars, you're not caught by those provisions. So you can still get the benefit of the arbitrage between the benefit in kind rate on the car versus the salary that you're giving up. EMI schemes, enterprise management incentive schemes, are proving as popular as ever. For those that don't know, these are an HMRC approved share option arrangement, and it's a way of incentivizing and retaining staff by giving them options over shares in the company. Very often they're structured as what we would call exit-based arrangements, so they only trigger when the business is ultimately sold. But what it does mean is that you can give an incentive to key people to stay with the business and help it grow. And on that sale, they can get a share of those proceeds in an extremely tax efficient way. We're a bit like business asset disposal relief, of course, as it's such an attractive tax environment that EMI schemes work in. There are a number of conditions which need to be met, and it's important that proper advice is taken before entering into the scheme to make sure that it does qualify and it will work for the company. Expenses, just a general point there about making sure the team have claimed all the eligible expenses for the year. Don't forget, the £6 a week working from home allowance, which we've been allowed for the last couple of years. If that hasn't been claimed, that's an easy win if anybody has had to work at home at any particular point in time. And there's a specific portal on the HMRC website, which you can go through in order to make that claim as well. So it's a very, very straightforward process there. And looking at profit extraction in general, I touched on earlier when we were talking about salaries, looking at salary dividend mix. With profit extraction, it may be time to think a bit broader than that. If there are any directors' loans to the company, you should consider charging interest on those loans, particularly in view of the 1.25% increase in the tax rates on dividends that are coming in. That increase does not apply to interest. And so you could charge an amount of interest to the company for providing a loan to the business. It should be tax deductible in the company itself, so long as it's paid within 12 months of the year end. And from the individual's perspective, it's just another way of pulling profits out of the company in a fairly tax efficient way. The same can be said for property as well. So if you have a scenario where the business owners own the property outside of the company, again, consider if rent is already charged at the moment, whether that rent represents a fair value. If no rent is charged, then consider charging rent on it. Again, rental income is excluded or is outside of the 1.25% increase in rates that are coming in April. You do need to be careful from a business asset disposal relief perspective if you are charging rents on properties used in the business, because it can impact the amount you can claim of business asset disposal relief on a future disposal of that property. But with the lifetime limits now at £1 million, if, for example, the shares in the company would break that limit in any event, then losing the BADR on the property may not be such a big issue. And you could be saving a little bit of income tax in the meantime. We'll now move on to some personal tax planning ideas and thoughts. Interspouse transfers, kind of a classic way of mitigating the tax liability of the family as such. Transfers of assets between spouses are usually on a nil gain, nil loss basis, so you don't ordinarily trigger any tax charge in transferring assets between spouses. When you're looking at shares in a company, for example, or a profit share in a partnership, it's important to remember this income range between 100,000 and just over 125,000, where you start to lose your personal allowance. And so the effective rate of income tax in that band is 60% on, say, employment income. So if you have two spouses, whereby one earns maybe 110,000 and the other earns £10,000, you may want to consider moving the 110,000 one to just below 100 and increasing the salary on the other one, for example, or the dividends between the two, just to avoid income falling within that particular range. Similar kind of concept when we're looking at salary sacrifice and exchanging salary for benefits. Classic example here is using employer pension contributions to get the salary below the £100,000 threshold. Pension contributions generally are a very tax efficient way of rewarding employees. The company would get a corporation tax deduction for the contribution. And from the individual's perspective, there's no benefit in kind on that contribution being made. Remember, from the company's point of view, it only gets relief on a paid basis for employer pension contributions. Dividends and bonuses, touched on this earlier. No need to necessarily go over that again. Point there is around the timing of the dividend payment or the bonus payment to avoid this 1.25% increase in tax. If you're in the position that you're already an additional rate taxpayer, so if income is already over £150,000, then it might be worth considering accelerating those payments, because you're not going to fall within any additional band by increasing your income in the current year. But do remember, what you are doing is that you're accelerating the payment date for the tax on that income by a year. So paying less tax by making those payments before the 6th of April by 1.25%, but paying that tax earlier. The flip side of that is if you have individuals who receive low levels of dividend income, you may want to defer in those dividends. And where we're coming from that perspective is making use of that £2,000 dividend nil rate band, just to make sure it's fully utilised in each period. Directors' loans, touched on this just now regarding charging interest on directors' loans to companies. You've got the savings allowance, which can be used if you're a basic rate taxpayer. And so that can be a beneficial way of, again, extracting profits from the company, but managing that personal tax liability. So basic rate taxpayers get £1,000, savings allowance, higher rate taxpayers get £500. All of these things all add up ultimately. Stamp duty land tax, we'll just touch on this. It's just a reminder more than anything else that you do have this 3% surcharge for second homes on SDLT. So it's important that that's not forgotten about when you're considering making a purchase of an additional property. And also remember that any property purchases through a limited company, will automatically have that 3% surcharge attached to the SDLT liability. Remember, if you are replacing your current home, you can avoid that 3% surcharge. There are various rules around the timing of that and how you go about paying it and reclaiming it should the case arise. So moving on now to inheritance tax. So clearly, what we've been talking about today is planning around the current tax year and the future. IHT is more about the longer term situation, hopefully in most cases. And because the nil rate ban for inheritance tax has been frozen now at £325,000 since April 2009, it does mean that more people are potentially being brought into the inheritance tax net. Remember, you got this residence nil rate band now, which does mean as a couple between you, you could have £1 million nil rate band being the main house and the normal inheritance tax nil rate band. But again, many conditions around that. If your estate is more than £2 million, then that benefit can start to get eroded of the residence nil rate band. Both the nil rate band and the residence nil rate band are another one of these allowances that are being frozen until April 2026. So some things to think about from an IHT perspective. Charitable gifting. So if you leave at least 10% of your estate to charity, the remainder of the estate has a reduced rate of IHT of 36% rather than 40%. And don't forget the annual allowance for IHT. So this means you can give away £3,000 of value every year without them being added to the value of your estate. And the allowance is carried over by a year as well. So you can have £6,000 worth if you haven't used the £3,000 in the year before. So that's a useful way of giving away small amounts in a piecemeal manner. Anything larger than that, then potentially you're looking at the 7-year rule, as we commonly call it. These are potentially exempt transfers and chargeable lifetime transfers, whereby so long as you survive 7 years from the date of the gift, the value of that gift then would fall outside of your estate. There are numerous nuances around that in terms of how those rules actually work, but that's the general rule there. With most gifts, they are what they call potentially exempt transfers, so you have no IHT to pay at all at the time of the gift. Some gifts being chargeable lifetime transfers, typically gifts to trusts or gifts to companies, they do attract a lifetime IHT lifetime tax rate of 20% on such gifts if they're not covered by the nil rate band or other reliefs. So just something to, again, remember from that perspective. Now, don't forget gifts out of income. So if you are making regular gifts, and this is above the £3,000 that we just talked about now, so you're making gifts on a regular basis and it doesn't impact your income, then these can be tax-free and from an inheritance tax perspective, and not be treated as lifetime gifts, and so you're not within the 7-year rule. Now, it's important that you document the making of those gifts. It just helps should the time arise where the revenue asks for proof, if you can produce a document which shows those gifts being made on a regular basis, and also showing that in making those gifts, it didn't impact your income levels or your lifestyle, then that's a very good way of being able to reduce your estate without having to worry about the 7-year rule. Passing on your pension, revisit your current plans and update your will to make sure that the family does receive the full benefits of the pension fund. It's now very easy to pass on your pension pot outside of IHT, so long as the relevant documentation is in place. And trusts do still have their place in inheritance tax planning. They're certainly not as tax efficient as they used to be, and you wouldn't necessarily use one for any sort of tax mitigation reasons, because they are subject to tax like everything else now. And indeed, most trusts attract tax at the high rates of income tax. But they're still useful in terms of asset protection. So protecting an asset, say, from divorce and such like. And also it helps with separating that ownership and control of assets as well. So if you want to get an asset out of your estate, but still effectively have influence over how that asset is used, a trust can be a useful mechanism for that. But the trusts in general are a very complex area, and so it is important that proper advice is taken before going down that particular route, because it's very, very difficult to unwind a trust situation without significant tax liabilities arising later on if you discover that it's not actually doing what you wanted it to do. So looking at pensions and tax now, you need to think about protecting your pension. The lifetime allowance has come down year on year, just over £1,073,000 now for 21-22. And indeed, this is another allowance that is frozen until April 26. So in effect, it will be eroded by inflation over time. The lifetime allowance is important because if your pension fund value goes over and above that, then there are some tax charges arising, the lifetime allowance charge. So it's important to keep an eye on that pension pot. The annual pension allowance, so generally speaking, you can invest up to £40,000 into a pension tax-free. That allowance does come down for higher earners. And that allowance can be carried over for 3 years if it's not fully utilised. So potentially you could have an allowance of £160,000 available. So the 3 years brought forward plus the current year. As I mentioned before, employer contributions are a very tax efficient way of rewarding employees. So it ties in with that as well. And in order to take advantage of that 3-year carryback, it is important that you actually had a pension scheme in those previous 3 periods in order to get the benefits of that brought forward relief. If you do go over that annual allowance in terms of your pension contributions, again, a bit like the lifetime allowance, there are some tax charges there which can penalise that. And don't forget, stakeholder pension. All UK residents, including children, can make net contributions of up to 3,600 gross, regardless of whether they have any earnings. This can sometimes be used for grandparents setting up a pension for grandchildren. From the grandparents' perspective, it may well qualify as a gift out of income, those annual contributions, and so you're not worrying about the 7-year rule from an IHT perspective. So it's a way of reducing the grandparents' estate, but at the same time, passing on some value to the grandkids in an efficient way. Clearly, the grandchildren can't get into that pension pot until they're 55. and it stands at the moment, but it's something else just to throw into the mix. And the pension drawdown. So if you are over 55, you can start drawing down pension benefits. You can take up to 25% tax-free, and then the balance is taxed at the marginal rate, your marginal tax rate. Just going through some tax-efficient investments here. Now, remember, you do need to take advice from an IFA in terms of whether these make sense for you personally from an investment perspective. So what I'm talking about is purely the tax benefits that these investment products give. ISAs, we've probably all heard of those. Share schemes, we talked about the EMI scheme earlier as being sort of the share scheme of choice for SME type businesses. EIS and SEIS, so this is the Enterprise Investment Scheme and the Seed Enterprise Investment Scheme. Now, both of these schemes are designed to encourage investment into smaller, newer, high-growth companies. They do tend to be at the riskier end of the investment spectrum. However, there are some very generous tax reliefs available by investing into those types of companies. You can get upfront income tax relief. So for EIS, it's 30%. For SEIS, it's 50%. So you invest £10,000. With EIS, you get £3,000 knocked off your tax bill. SEIS, you get £5,000 knocked off your tax bill. And also, after 3 years of owning those shares, you can have a capital gains tax-free disposal. So very attractive, particularly if you don't qualify for business asset disposal relief. You're then mitigating capital gains tax, which is currently at 20%. Just a word of warning around those schemes, there are numerous qualifying conditions which need to be met, and numerous bear traps which you can fall into quite innocently if things aren't done in the right way. So whilst the reliefs are there and very attractive, it's important that you take some solid tax advice and indeed investment advice before going into those type of arrangements. Venture capital trusts, they're a bit similar to EIS and SEIS. Community investments, social enterprise investments, again, you can get tax relief on those by investing into qualifying businesses falling under those categories. And life assurance bonds and offshore bonds, again, are a way of mitigating tax liability by investing into those products. So a suite of ideas there, but like I mentioned, it's important that you take investment advice before going down those particular routes. So finally, let's take a look at making tax digital for VAT. Number of changes afoot here. As a reminder, what is making tax digital? Well, it's HMRC's plan to digitise the tax system. It's going to be rolled out into income tax as well as eventually corporation tax as well. The requirement here is for businesses to use HMRC compliant software. From HMRC's perspective, it's all about having that audit trail of where the numbers have come from. And reporting is to be done on a quarterly basis. So hasn't it already gone the way? It has, yes. Businesses which were above the VAT registration threshold of 85,000 have had to comply with MTD since April 2019. And one thing that became apparent was that there was a huge underestimation by many businesses of the preparation that was necessary to comply with the various conditions and mechanism for reporting under MTD. There was a recognition of this in that there was a soft landing period in terms of penalties for non-compliance, for example, but that ended in 2020. And for new businesses going forward, you no longer get this. So it's straight into the that kind of compliance environment. So what are the upcoming changes? So from April this year, just over a month away, the regime is extended to all VAT registered organisations. So that's including those below the threshold and those who voluntarily registered for VAT. So those businesses must follow the same rules that businesses which are currently in the regime follow. So using HMRC compliant software and recording and reporting the VAT information quarterly. So what do businesses need to do to prepare for this? A list there, which I won't go into in any detail, but in essence, the software must be capable of keeping records in digital form and preserving those records. It must be capable of creating a VAT return from the digital records and also a tax return in due course. The software should be able to provide HMRC with the VAT and tax data voluntarily, and HMRC must be able to receive that data via their API platform. So it's important that the right software is acquired. Now, systems like Xero and QuickBooks and such like, they're already or should already be set up for dealing with this. So we'll end here with a bit of a colourful chart for you to look at. This is the roadmap, in essence, of MTD from where we've come from in April 2019, when VAT registered businesses over the threshold had to report, through to the future. So at the moment, we've got the change coming in April 22, as I just mentioned. In April 24, this is still the start date for income tax under MTD. So this is where the self-employed and business and landlords with annual income over £10,000 will have to start reporting their profits and income on a quarterly basis. That's going to be a big change. And then 2026 is penciled in as the earliest date for corporation tax falling within the Making Tax Digital regime. Now, of course, from April 24 for unincorporated businesses, and this is probably no coincidence, we also have the basis period changes coming in from that date as well, whereby unincorporated businesses, so sole traders, partnerships and such like, they will, after that date, be taxed on a tax year basis, irrespective of the accounting period adopted for that business. So that ties in with MTD coming in for income tax. So thank you for listening. We have got a couple of minutes left for some questions. Let's just see what's coming in. It's an interesting one. I don't know if I know the answer to this one, which is not particularly helpful for you, John. But son-in-law can't sell the flat due to cladding. Is moving and buying a new flat anyway. Can he avoid the extra 3% his current flat is unsellable, worthless? Yeah, that's a really good point, because you do have this period where so long as you move into your new main residence within the period from selling your old one, you might have to pay the initial 3%, but then you can claim it back. Now, I believe there are some provisions there for extenuating circumstances, which this may fall within, but I don't know for sure to what extent this may fall within those provisions. Leave that with me, John, and I will get back to you separately on that. I'll see if I can find what the answer might be to that. But that's an interesting one, because clearly it's out of your son-in-law's control, the fact that he can't sell his existing residence. What else have we got? Super deduction. Is there a difference between hire purchase and finance leased assets? Yes, there is. Yeah, with assets acquired on HP, you should be able to claim the super deduction for those assets because you do take ownership ultimately of them. The finance leased assets, generally they won't qualify for the super deduction because they're treated as a financing transaction as far as tax and the accounts are concerned. So yes for HP, no for finance lease. Classic question. Do you think there'll be any changes announced in the spring statement on the 23rd of March? Yeah, so we've got it's not been badged as a budget, but there is an announcement. Chancellor standing up again on 23rd of March with the spring statement. I wish I had a crystal ball. I think anything is on the table at the moment. Clearly, we had the budget back in October, and indeed prior to that budget, the 1.25% increase in tax rates was announced. I was surprised there were no capital gains tax changes in the October announcement. So whether that's being kept up the sleeve for next month, it's been widely trailed for a while now that CGT rates are going to change. It shouldn't be forgotten that it's not that long ago, 10, 12 years ago, that CGT rates and income tax rates were aligned. So we've had this period of time where we had this lower rate of CGT. I suspect that is one area that could be susceptible to challenge, but yeah, all bets are off at the moment on that. Let's wait and see, and I'll be waiting in anticipation to see what comes through there. There might be no tax announcements at all. Like I say, it hasn't been badged as a budget, so there doesn't have to be any tax announcements made. Question in from Alex. Hi, Alex. Good to hear from you. Tax overview on cryptocurrency. Some large organizations are adding to their balance sheets. Yeah, crypto is clearly something that's coming more and more to the fore. We're certainly seeing more clients with those transactions going through. In essence, from an individual perspective, if you're dealing in crypto, then generally speaking, it's a capital gains tax asset. And so you have a capital gains tax to pay on any gains made in the tax year. It could fall into income tax if you're deemed to be a trader in crypto, but you'd have to be doing it all the time, pretty much. Likewise, in a corporate environment, because companies pay corporation tax at the same rate, whether it's a capital or income transaction, that particular aspect is irrelevant. But suffice to say, crypto transactions will be taxable or tax deductible, of course, depending on which way it goes in companies. The revenue is slowly catching up with this. Some guidance was released last year. But of course, it's such a fast-moving sort of environment that crypto is in that it's difficult to keep a pace with things. Well, thank you very much, everybody, for listening. I hope you all found that useful. Like I say, we will circulate these slides around to all the participants, and I hope to see you again soon. Thank you.